Welcome to TSAT. We are discussing about monetary policy, and this is the third part of the series in monetary policy. The first video we discussed about the definition of monetary policy and the objectives of monetary policy and what are various functions RBI performs other than simply formulating and reviewing policy, that is monetary policy once in a while. The second part we started with the various tools of monetary policy, both quantitative and qualitative, and I started certain discussions related to certain types of quantitative tools of monetary policy. The first is the reserve ratios, that is cash reserve ratio and statutory liquidity ratio, and how RBI would help could alter the supply of money, or banks could simply alter the supply of credit by simply RBI changing this cash reserve ratio and statutory liquidity ratio. Then we also discussed about the liquidity adjustment facility, what we call mostly through the repo operations, repo rate and reverse repo rate. So increase in all these either reserve ratios or increase in repo or reverse repo rate would result in a tight money policy, and decrease in either reserve ratios or decrease in this repo or reverse repo rate would help in easy money policy. That's what we concluded in the last session. And now let's go ahead with one of the very traditionally used and most prominently used those days prior to liquidity adjustment facility, that is what we call bank rate. And in fact, if you look at the definition of bank rate is very similar to the repo rate. Then you might be confused, then we already have simply a bank rate. So what is a bank rate? The rate at which RBI lends money to the banks. That's it, the rate at which RBI lends money to the banks. And this is a very similar definition that I have been given when it comes to repo rate. Repo rate is also the rate at which banks borrow money from RBI or the rate at which RBI lends money to the banks. Then how is this bank rate different from repo rate? The only thing is it's a duration, that's it. So let's not go into the integrity of both what exactly is the duration, but when in general, just remember it, when the loans are for long term, then generally banks charges bank rate, and generally when it comes to a daily basis or fortnightly basis overnight borrowings, the rate at which the banks borrow is basically at the prevailing policy rate, or what we call repo rate. That's it. So short term borrowing rate is repo rate, long term borrowing is bank rate. That's very easy, and that would be the best way to remember. So and I think you could simply now understand the fact when this bank rate increases, I mean when the rate at which RBI lends money to these banks increases, and don't you really think the lending rate of these banks obviously increases, because it has become very costly for the banks to borrow money from the RBI. So whenever the bank rate increases, something similar to repo rate increasing, the lending rate of interest increases. Henceforth, we could conclude the fact that increase in bank rate signals a tight money policy, decrease in bank rate signals easy money policy. So that's how you could remember the fact. That's what's the meaning of a bank rate. And now let's go ahead with certain other policy instruments that you might have been already aware. So one is marginal standing facility. One is marginal standing facility, MSF, very popularly called as a MSF. And recently, it's also been introduced what we call standing deposit facility. Standing deposit facility. So what exactly these two mean, and how do they happen to play a role in simply formulating monetary policy or simply altering the supply of money and credit in the economy? So first one is marginal standing facility. So it's very similar to liquidity adjustment facility. This marginal standing facility has been introduced by the RBI somewhere roughly in the year of 2008. So if you look at marginal standing facility is again the rate at which RBI lends money to the banks. So the thing is that under repo window they do have certain limitations. There are certain restrictions with respect to the amount of money they could borrow. And also the duration. So whereas the RBI, the RBI has come up with an one more initiative where the banks would have an opportunity to borrow an extra amount of money with certain different types of conditions, which we would not be discussing as part of this session. But just remember the fact, marginal standing facility is an extra or one more opportunity provided by the RBI to facilitate lending to the banks. And as part of this particular window, banks would have relatively better freedom to raise some money, and you have different kind of rules when it comes to borrowing money under MSF. So let's not simply dig deep into it, but just remember the fact, since this is again a rate of interest charged upon the loans extended, whenever the MSF rate increases, the banks need to pay higher rate of interest to the RBI. As a result, increase in MSF rate results in a tight money policy, and decrease in MSF results in a easy money policy. So that's what is worthy enough to remember for the examination. Now coming to the standing deposit facility. Standing deposit facility is very similar to reverse repo rate. very similar to reverse repo rate. Simply it does mean, okay, you remember reverse repo rate is the rate at which RBI borrows money from the banks, or the rate at which RBI, okay, banks park their money with the RBI. Then what is standing deposit facility? Standing deposit facility is simply very similar to reverse repo rate, wherein when banks park their money with RBI, the RBI pays them certain rate of interest. Then what's the difference between these two? When it comes to reverse repo rate, when RBI borrows money from the banks, the RBI happen to keep certain amount of assets that RBI has with them, mostly the government securities or government bonds. So simply, okay, you all know the fact. Just imagine you approach a bank and would like to tell the banker, I would like to borrow money. What do you think the banker would be expecting from you? He would be expecting some mortgage, or he would be expecting some collateral, like guarantee, isn't it? The same logic holds good whenever banks borrow money from RBI or RBI borrows money from banks. As I discussed in the previous session, that RBI, banks do borrow money from RBI through repo window. So whenever these banks borrow money from RBI through repo window, the RBI expect the banks to keep certain amount of assets the bank has as a collateral, or what you call simple terms as security. Similarly, as part of reverse repo rate, the RBI is also expected to use certain amount of assets. Mostly the assets here in this case would be government bonds, mostly. Okay. So similarly, the RBI is also expected to park certain amount of collateral or certain amount of government bonds as a collateral whenever it raises money from the banks when it comes to reverse repo rate. But whereas when it comes to standing deposit facility, here in this case, the RBI is not mandated, not required to park any assets as a collateral with the banks when it comes to raising money from the banks, and henceforth under this window RBI has a right to raise money from the banks without using any collateral. That's it. That's the only difference. Okay. But whenever the banks park money with RBI, and where RBI doesn't park, okay, doesn't simply keep any assets with the banks as a collateral, in such case the rate of interest that banks gets paid is what we call standing deposit facility. So now imagine if the RBI simply says the bankers, for the money you park with me, you would be getting paid higher rate of interest. Obviously, the banks would be happy parking their money with the RBI. So henceforth, you could conclude the fact whenever the standing deposit facility increases, the RBI is trying to signal the market that it is going for a tight money policy. In a way, it is discouraging banks to lend money to the markets, rather park the money with the RBI. So whenever the standing deposit facility decreases, in a way the RBI is telling the banks, for the money you keep with me, I would not pay you very high rate of interest, rather there a very cheaper rate of interest is what you get paid. In such case, the RBI is simply trying to signal the markets that it is going for a easy money policy, or discouraging banks to keep their money with the RBI, rather it is encouraging banks to lend money to the markets rather than keeping with the RBI. So that's how, okay, something similar to repo rate and reverse repo rate. Increase in either repo and reverse repo rate, we concluded that results in tight money policy. Decrease in those rates results in easy money policy. And same logic could also be extended here. MSF rate increase or standing deposit facility rate increases results in tight money policy. Decrease in both MSF rate, bank rate and standing deposit facility rate, decrease in all these rates will result in easy money policy. So the logic remains the same. The only thing is that RBI has different policy instruments, and each of these policy instruments comes with the different terms and conditions. Okay, but only thing you need to remember is what are the different types of policy instruments and how do they really have an influence upon the banking system, and how does that influence the credit supply in the economy and interest rates. That's more than enough for the examination. Okay. So now let's look at the most important and very popularly used instrument of monetary policy in most of the Western countries, and it has also become very popular in the recent past in countries like India. What we very commonly refer as open market operations. Okay, OMO stands for open market operations. Open market operations. Okay, beyond, okay, there is a subtle difference between, very small difference between the way RBI alters the supply of money or RBI influences the interest rates when it comes to the previous cases. But when it comes to this particular situation, you just simply note down the fact that this way of influencing supply of money by RBI is through different means. So what do you mean by open market operations? Open market operations simply does mean the practice of RBI, either selling or buying government securities, or you could simply say government bonds, to influence government securities or government bonds to influence the supply of money. To influence the supply of money is what we call as open market operations. So how does RBI simply selling and buying bonds would help in altering supply of money? Now you know the fact that, my friends, the bonds that we purchase from Government of India could be traded in the market freely. Because what is a bond? A bond is a borrowing instrument. A bond is a borrowing instrument. So let's say take the case of Government of India. So if the Government of India is in need of money, typically what does the Government of India does? It happens to print a piece of paper. Generally, this is what we call a bond. Of course, in modern days, we don't have such kind of physical papers. Everything has been digital. But just imagine, I'm just trying to let you understand how things work in good old days. So what does the RBI simply, what does the government does? They go, I am in need of some 10,000 rupees of money. And this 10,000 rupees of, is what we call as face value of this bond. Face value of this bond. And whosoever buys this piece of paper or this bond, I'll pay them 10% annual rate of interest. I'll pay them 10% annual rate of interest. Does mean upon 10,000 you get paid 10% of annual rate of interest. Mean for every 1 year you get paid 1,000 rupees as a interest. And this 1,000 rupees interest could be paid annually or semi-annually. I mean once in every 6 months 500 rupees, or once in every year you get paid 1,000 rupees. And this bond has a maturity period, let's say 10 years. That's mean 10 years later, you get paid whatever the principal amount that has been printed on this piece of paper. That is nothing but a face value. So that's mean today whosoever whosoever buys this piece of paper, to that particular person, the bearer of this bond, I promise them I will pay 10% rate of interest every year. And 10 years later, whosoever has this piece of paper could redeem for an amount of 10,000 rupees, which is what is called face value of the bond. And this bond is what the government markets in the, markets it. So once the bond is being sold, depending upon the returns upon the bond, people would be purchasing at different prices. And the price of the bond changes with the rate of interest in the markets. And we are not going to discuss as part of this session, but I think you would be able to figure it out. Like the way we purchase and sell assets based upon the returns upon the assets. Similarly, this bond as an asset could also be traded. So what is the RBI telling the markets is, I am here to buy some securities. I am here to buy some government bonds. Now let's imagine the RBI is simply going for buying government bonds in the market. So when RBI simply comes to the market and tells that I am willing to buy government bonds, it does mean whosoever is the person who has government bond, you give it to me, in return I will pay you some money for the bond I am buying. So as a result, what happens when RBI goes for buying bonds, RBI is simply taking piece of paper, I bond from you and paying money for the market. So what happens? The money is flowing from RBI to the market. As a result, that particular action of RBI buying bond from the market results in increase in supply of money. As a result, it results in easy money policy or cheap money policy. Whereas when RBI is selling bonds to the market, does mean, what is the RBI simply saying? I have a piece of paper which pays you certain rate of interest and this has a maturity period which I happen to purchase from the government. If you are willing, I would like to sell it to you. Imagine someone like me thinks this is a very attractive instrument and this is worth investing. The reason is simple. Let's say, imagine I am a person who has 10,000 rupees in my pocket. And I think, and I am not in need of this money for next 1 year. That's what I am anticipating. If I go to a bank and keep this money in a bank which pays me 5% rate of interest, does mean upon 10,000 I only get 5% rate of interest per annum. And 5% rate of interest seems to be very low, then compared to 10% rate of interest this particular bond is paying. So I would think compared to 5%, compared to a deposit of my money in a bank at 5%, it is worth the investing in this bond. And let's say if I end up going and purchasing this 10% rupees bond, 10% interest bearing bond, so that's how I invested in an asset. That's nothing but government bond. So what is the RBI simply saying? I have certain amount of government bonds and these bonds happens to bear a face value of certain amount and pays a certain X% rate of interest, has a maturity period of certain amount of time period. If anyone is willing to purchase, I am willing to sell it. So when RBI ends up simply selling securities, look at how the money is flowing. We people are purchasing securities. It does mean that from my pocket, the money leaves to the RBI. In return, I get a piece of a paper. So what is happening? The money, the RBI is simply sucking money from the markets. As a result, what could be the impact upon the total money supply in the economy? The total money supply in the economy reduces because money is flowing from market to the RBI. So whenever RBI sells bonds to the market, money flows from market to RBI. Whenever RBI buys bond from the market, what happens? Money flows from RBI to the market. So this results, RBI buying it would result in easy money policy. RBI buying securities results in easy money policy. RBI selling securities results in a tight money policy because the money supply in the economy reduces. So that is how RBI plays a very instrumental role in altering supply of money by simply selling and buying government bonds. And this initiative is what very popularly referred as open market operations. Okay, so you could simply look at in this case particularly. So who could purchase these government bonds? It's not necessarily only banks. Anyone you. Okay, so a non-banking financial company, anyone in the market, whoever is willing to invest, because government bonds simply it has been a piece of paper government is selling to raise money from the markets. Simply a promise by the government to repay certain amount of money along with certain interest rate in the future, and that's what's the government bond. And henceforth, I referred bond as a borrowing instrument. Okay, so at the end of the day, if you look at, my friends, the total influence of monetary policy or the total supply of money is something that takes place by the RBI playing a proactive role, and the most important institution that happens to be involved in this so-called monetary policy is the banking system. So majority of the times what does RBI does? RBI signals the policy rates, or RBI uses the instruments, thereby influencing the credit supply within the banking system, and these particular banks, based upon the impact of the policy rates, they happen to alter the lending rate of interest and saving rate of interest in the market, and that's how at the end of the day these banks along with RBI happen to have a very large amount of influence on total money supply and also total money supply and credit supply. So this is how the RBI using various policy instruments could alter the supply of money. Okay, so now let's go ahead with one important tool of monetary policy that has been very popular and having impact across the world and has become a very common topic of debate, and this is what we call quantitative easing. Quantitative easing. Okay, many times people might have heard about these days. Okay, people refer it as QE, and sometimes people criticize this kind of initiative as helicopter drop. Okay, this term has become very popular because some of the people who has criticized this kind of initiative as something similar to helicopter drop. So if you look at in this picture, here is a former Federal Reserve chairman, where he is simply this picture shows that he is simply taking a helicopter and dropping dollars across United States of America. The reason it has become popular, quantitative easing is very similar to open market operations. It's very similar to open market operations. So what do you mean by quantitative easing? So traditionally, quantitative easing is defined as an unconventional tool of monetary policy. An unconventional tool of monetary policy. So anything not part of convention, the routine convention, or unconventional has been somewhere you happen to do it in an exceptional basis. An unconventional tool of monetary policy where central banks use it in order to influence the supply of money on a larger scale. So what so happened if you look at the recent case, somewhere in the year of 2008, when United States of America experienced a great, relatively large extent of financial crisis. I think you might heard about this so-called global financial crisis and the crisis in United States of America that originated in 2008. So what happened? The American economy experiencing a negative growth rates. As a result, the Federal Reserve, we in India call Reserve Bank of India. The Central Bank of India is referred as Reserve Bank of India, whereas when it comes to United States of America, they are referred as Federal Reserve. Okay, something very similar to what RBI does in India. So in United States of America, the Federal Reserve does the similar kind of job. In India, we call the head of RBI as RBI governor, whereas in the United States of America, they call that particular head of Federal Reserve as Federal Reserve chairman. So here in this case, what happened in 2008, when the American economy is experiencing a deep financial crisis, an economic crisis, that central bank has come with a policy initiative of increasing supply of money by purchasing government securities on a very large scale from the markets. So those days they happened to come with an initiative to purchase around $800 billion worth government securities from the market. And $800 billion worth security from the market, is going to result in a very huge increase in supply of money. Is going to result in a very huge amount of because when the central bank or when the Federal Reserve of United States of America is purchasing such a huge amount of bonds from the market, in return it is simply pumping $800 billion into the market. So when there's such a large amount of dollars started flowing into American markets, what was the expectation of the Federal Reserve of United States of America? These cheaper dollars in USA would help in bringing down the interest rates, and when the interest rates decreases, the credit offtake or the credit supply increases, and the offtake of credit increases, people would be happy borrowing and spending or consuming, and investors would also happy borrowing and investing. As a result, the overall demand in the economy increases, and henceforth, in order to revive the economy in a very short span of time, the Federal Reserve of United States of America those days has come with this idea of purchasing a large number of government securities and and simply pumping more amount of money to the markets in a very short span of time. And since since this is somewhere an exceptionally used tools of monetary policy, and that's the reason this word quantitative easing, of course, is being practiced many a times, but since 2008, later in European Union also happened other similar things, and even in the recent past during the COVID time, the Federal Reserve has done the similar kind of initiative, and that's the reason this word has become very popular, quantitative easing. So under quantitative easing, what do you think typically these particular bankers does or central banks does? They happen to do something very similar to open market operations. What do? They either buy or sell the securities, but here in this case they happen to do this on a very large scale in a very short span of time, and that's the reason it is called an unconventional tool of monetary policy. Okay, so along with this, I think you might have been aware of the term that is Fed tapering. Let me also make it clear with respect to Fed tapering. So in the recent past, we might be aware of, all people might have been aware of the fact that the rupee, one strange thing that is happening in India is the rupee is appreciating. Okay, so in the recent past, we all has observed the rupee is appreciating against large number of global currencies, like compared to euro, and then pound sterling, the rupee is appreciating. And at the same time, the rupee is depreciating. Okay, you might have noticed the fact the rupee is depreciating against dollar. Against dollar, the rupee is becoming weak. But whereas when it comes to other currencies, rupee is appreciating. So the reason why, and many times you might have been tracing the reason behind it is Fed tapering. So what's the reason behind this? It's simple. So look at it during the time of COVID, when most of the economies, not most of the, almost every economy across the globe has experienced a crisis, isn't it? Even India in 2020, this particular financial year 2021, we experienced a minus 7.7% fall in growth. Something similar happened even in United States of America. So in order to overcome this crisis, what is the Federal Reserve Federal Reserve happened to do in United States of America in those days is they happen to go for a easy money policy. And how come? By simply pumping more and more money. And what did they do? They happened to go for quantitative easing and started purchasing government securities on a very large scale, thereby pumping more money into the market. And when Americans started pumping more money into the market, what happened to the dollar supply in the United States of America? They increased. When dollar supply increased, what happened to the interest rates in the United States of America? They decreased. And when there are large number of dollars available at cheaper rates in the United States of America, so what is the obvious thing to happen? That would help in revival of American economy. And since dollars are universally acceptable, dollar being a hard currency as I discussed in the previous session, these dollars not only helped in reviving American economy, these dollars started also flowing into other countries like India as in the form of investments, because when Americans or when any other people happen to have dollars at a cheaper rates, people would be obviously interested in borrowing these dollars at cheaper rates, and these dollars started simply chasing investments in other nations. So now imagine, what do you think is the impact of cheaper dollars in United States of America? These cheaper dollars in United States of America started flooding countries like India. So because the interest rates in US is very cheaper, dollar is available at a very cheaper rate of interest. As a result, what happened? These dollars started chasing rupees. Because all these investors in United States of America or across the globe started borrowing these cheaper dollars in United States of America at a cheaper rates and started bringing this particular money into markets like India. As a result, what happened? Too many dollars started chasing too few rupees, very few rupees. So as a result, what happens? Rupee has relatively become stronger. That's the reason I think you might have noticed the fact, though rupee is depreciating right now in August, if you look at this is somewhere around August 2022, as of now rupee is depreciating. But if you look at during COVID time, there are hardly any such kind of phenomena. The reason is there are too many dollars available in the United States of America, and they started flowing Indian rupees, and as a result, rupee relatively remained stable. But what so happened in the recent past? Now the American economy was no longer able to continue the easy money policy. And recently, if you look at for the past 4 or 5 months, because of high inflation within the United States of America, the Federal Reserve of United States of America started reducing started increasing the interest rates in the United States of America, So what is the Federal Reserve simply saying? We are no longer interested in simply purchasing more securities from the market and simply infusing more dollars. Right now, we cannot afford to simply go for an easy money policy. Rather, okay, since our objective is to contain inflation, that is our most important criteria, priority. Henceforth, the Federal Reserve recently started reducing the number of securities it is purchasing from the market. And this initiative or this policy action of Federal Reserve reducing the number of securities or the volume of securities purchased from the market is generally what is referred with the term called Fed tapering. It has tapered its policy. It's a easy money policy. That's it. Okay, it has tapered. That has been altered its easy money policy and made it clear I cannot afford to purchase more and more securities from the market and infuse more money because inflation has become a major criteria constraint. And henceforth, I need to address that particular inflation because you might be aware of the fact the inflation right now in United States of America is almost the highest in the past 40 years. And henceforth, the Federal Reserve made it clear our basic objective or priority is to contain inflation. And as a result, we are going to keep the money tight. And because of this money being tight in United States of America, the interest rates in United States of America happen to increase. When the interest rates for dollars in USA started increasing, what happened? The dollars from countries like India started leaving because the dollar has become more costly in nations like in the market of United States of America. So as a result, once many dollars started leaving markets of India, what happened? The demand for dollar increased all of a sudden, and whereas the supply of dollar decreased, and that's being the reason why rupee is depreciating in the recent past. Okay. So, and this initiative of RBI is what we call it as a Fed tapering. This is what we generally refer as a Fed tapering. Okay. So, what I mean to say is this initiative of RBI, okay, or the purpose of this particular discussion of open market operations and then quantitative easing and then Fed tapering is to let you understand the policy actions of a central bank of a particular country would not have its impact not only within the country. If you look at the policy actions of Federal Reserve, and most of you when you go through newspaper, you might have also seen the media reporting what is simply the Federal Reserve of United States of America doing, what is the Central Bank of China doing. Why would people report it? Because any policy actions of the Federal Reserve of United States of America would not only have its impact within the United States of America, it would also have repercussions outside United States of America. So if dollar becomes costly or if the interest rate for dollar increases, that would have an effect upon the value of rupee, because when dollar becomes precious in United States of America, people would not be happy borrowing more dollars from USA and invest. Rather, dollars start leaving from other markets to United States of America because dollar has become very costly, or dollar has become, the interest rates on the dollar has become very high. It's as simple as that, my friends. If you look at it, you have certain amount of money and you have a freedom to keep your money or save money in two different places. One place, or one particular bank pays you 6% rate of interest, other bank pays you 8% rate of interest. Which bank would you be interested in parking your money? The bank that pays higher rate of interest. The same thing holds good. Now imagine a person has a dollar in his pocket, and this dollar is what he borrowed from a country where the dollar is available at cheaper rates. Now when he knows the fact for these dollars, the American economy is paying a very high rate of interest, what do you think people would be doing? They would take the dollars from those places where they have invested to American economy where the rate of interest is higher, and as a result, too many dollars leaving the country like India resulted in rupee depreciating against dollar. And this is what is being traced to the policy initiative, that is what is being named as a Fed tapering. So what is the Fed tapering? The policy action of Central Bank of United States of America, that is none other than Federal Reserve, tapering its policy or altering its easy money policy to make dollar costly or to increase interest rates to contain the phenomenon of inflation. So now you might be thinking, how could it would have an effect upon our economy? Now look at it. When too many dollars started leaving, when too many dollars started chasing Indian rupee, rupee might have become stronger. In fact, you will be surprised to know in the years of 2008-9, when too many dollars started chasing Indian rupee, rupee has appreciated and has become so strong, it almost touched to somewhere around 45, 46. But whereas if you look at in the modern days, the rupee has depreciated somewhere almost approximately to 80 rupees. And what do you think would be the consequence when rupee becomes weak? Okay, the consequence is very simple. Okay, when too many dollars started leaving this country, rupee ends up depreciating. And what do you think is the consequence when rupee depreciates? When rupee depreciates, Now let's simply see. Rupee is depreciating against a dollar. What do you think could be the impact? Let's say rupee, 60 rupees right now can buy a dollar. And for some reasons, the rupee has depreciated from 60 to 80 rupees. For some reason, the rupee has depreciated from 60 to 80 rupees. So let's say one day it was 60 rupees per dollar. Does mean you could get $1 for every 60 rupees. The other day it so happened you need to forego 80 rupees to buy a dollar. I mean, that's what the exchange rate right now with respect to dollar and rupee. In such case, what do you think would be the consequence? Now let's imagine, okay, 1 barrel of crude oil is available at $50. In the global markets, 1 barrel of crude oil is $50. And when 60 rupees can buy you a dollar in India, does mean you need 60 rupees per dollar. And how many dollars you need? $50 to buy 1 barrel of crude oil. So henceforth, what happens with 3000 rupees, you would get 1 barrel of crude oil. But when imagine the crude oil price remained the same, but rupee for some reasons has depreciated. In such case, the amount of money you need to forego or you need to spend to buy 1 barrel of crude oil right now would be, 1 barrel of crude oil is $50 and each dollar is rupees 80. So what do you think is the amount of money you need to spend? It is going to be around 4000 rupees to purchase the same barrel of crude oil. So what happened to the crude oil prices? In terms of rupee, crude oil prices has increased. In terms of rupees, when crude oil prices increases, what happens to the petrol, diesel and other petroleum related products? They increase. And as a result, what happens to the cost of transportation of various goods, raw materials and finished products in the country? It increases. And as a result, what happens to the prices of goods and services in India? It increases. And this is resulting in inflation. And that's the reason why, you could trace the war of Russia with Ukraine and dollars leaving from markets from India because of high rates of interest in the United States of America to why rupee is depreciating. At the same time, rising crude oil prices, which is resulting in a very high inflation even in countries like India. So having seen how rupee, the value of rupee or simply how the policy actions of one central bank would have an effect on other particular nations. So I have given an example of Federal Reserve. So the actions of Federal Reserve of United States of America, how does it would have an influence upon the monetary policy or it would have an impact on countries like India, isn't it? So the more stronger your economy, the more stronger your currency, the more would be the impact upon you of your policy actions. That's a very basic reason why you might have noticed the fact that the RBI, whenever it makes any policy changes, it would also keeps in mind what exactly is the Federal Reserve of United States of America is going to do, what is that the Central Bank of China is going to do, what is that the European Central Bank is going to do, because the policy actions of these central banks, their actions would not have impact only constrained or restricted to the borders of the respective countries. That would have repercussions across the nations and across the borders, and that's how the monetary policy is so important. So now finally let's conclude the fact with what we have discussed in the previous session already, that as of now, if you look at since 2015, I already made it clear there is an agreement between RBI and Government of India, what is very popularly referred as monetary policy framework agreement, wherein the RBI has been mandated as of now is to keep the inflation under control, that is 4 plus or minus 2%, which has been already discussed in the topic of inflation, and that's what we is very popularly referred in India as inflation targeting. So I just don't want to repeat it here as it's been already discussed. So what does the inflation targeting does mean? As part of monetary policy framework agreement, the RBI is being mandated to tackle the inflation or keep the inflation within a range of 4 plus or minus 2%. And what inflation the RBI is expected to tackle? It is the consumer price index based inflation, what is very commonly referred as retail inflation. So in this particular, as part of monetary policy, we have discussed about the objectives of monetary policy, the definition of monetary policy, various instruments of monetary policy, and we ended up concluding with how monetary policy actions of one particular central bank of a country would have its repercussions across the borders, and that's the purpose of discussion of this topic called quantitative easing. And I also defined term what is Fed tapering and how the monetary policy actions of Federal Reserve of United States of America would have an effect upon the value of rupee in India, and further how does this change in value of rupee or either appreciation, depreciation of rupee would have an effect upon Indian economy. So that's how the monetary policy plays a very important or a crucial role in altering the supply of money, supply of credit, and thereby influencing the both growth and also inflation. Thank you.